Moving on, and it's time to get a look at the markets. On Wednesday, we were joined by Tredas' Doug Simon, and we had a lot to ask him, including, is now the right time for producers to start locking in some of their input costs? And how should some farmers be confronting market risk as Phase 1 and USMCA get rolling? But we started off by asking just how the Wuhan coronavirus has impacted the markets and commodities.
Yeah, it's been a little quiet. I mean, the market's still been pretty volatile, but maybe not quite as much concern over the coronavirus. I think everybody's trying to figure out how deadly it's going to be. I mean, for lack of a better word. I mean, SARS and MERS, those were pretty deadly. And right now, it's not quite that, to that degree. But I think everybody's trying to figure that out, and it's got a longer incubation period, so it's really an uncertain thing. So we've had a lot of volatility, especially last Friday, and then Monday, Tuesday of this week, quite a bit of concern over it, but seemed to be less concern over it today than there had been.
So we're looking forward to the upcoming WASDE report here in a couple weeks. What kind of projections do you have for that?
Well, we had the January report, which was pretty big report, but not a lot of changes in there other than like that cattle on, the feed numbers that, were actually boosted up, which made some sense now finally to me. But for the February report, and I don't think they'll really adjust a whole lot in there. Probably internationally, Argentina, Brazil. Argentina yields on soybeans have been coming in better than expected. It's been a touch dry in Argentina, but there's some rain slated to be there. So I think it'll be more international kind of, adjustments there. And really March 30th, the end of the year, end of the quarter there, they'll have stocks again, they'll have acres. That'll be, I think, probably bigger, more interesting information on that March 30th report as we go out there toward the end of the first quarter.
All right, so moving on to trade, this week USDA announced a sizable sale of corn to Mexico for the 2019-2020 marketing year. Are we starting to see the positive effects of the USMCA Act, even though it hasn't fully gone into effect yet?
I think they just maybe signed that today, which is
yeah.
good. And then, so, I was looking at some of the numbers. Mexico was actually down last year on their corn crop like 10% from what it was the previous year. So our exports are up about 5%, should be up about 5%, which is good. So part of it's, what's going on domestically there. I think we're worried maybe longer term they might try to shift more corn to Argentina or Brazil or something like that. So I think it is good that they've got that signed. And Mexico's been, with Japan have been our two largest corn export markets. And actually Mexico's outpacing Japan now, pretty well. So it is positive that we've got that taken care of and moving on to hopefully some other bilateral trade negotiations too.
So we'll move on to risk management. What advice would you have for people as far as production risk that producers should be focusing on this time of year?
That's a good question, because it's the time of the year that my colleagues and I at Tredas, we always start looking at making new crop sales in this, what you consider to be kind of a seasonally favorable time frame. They've done a lot of work at Iowa State University and University of Illinois, what's the best marketing strategy. And typically you want to sell increments, between February and June, and that's what we like to do. And so we've already made a couple increments this year. We had some opportunities last summer and then back in October when corn rallied. But, D's corn right now, this week's back down to $3.94. Last week we were back up to $4.04. Beans were $9.80, 3 weeks ago, and now they've fallen off, quite a bit from where they were. But we're in that season where we always like to look at pre-harvest marketing strategies, because 75% of the time you tend to go lower into the fall. And so we want to be making those increments like we did last year and like we've done in the years past. But that average price last year was $4 in the spring, basically from February 15th to June 15th. And so whenever there's strength in there, we like to sell, and that's what we're looking at. We're not going to sell all of our crop, but we'll look at our crop insurance guarantee, because you've got revenue kind of coverage and production coverage implicit in that. And then start making sales relative to that crop insurance guarantee. And that's a very sound marketing strategy. We always look at locking in futures ahead of time. We'll trade basis and carry next fall when we know a little more about the crop size and what those spreads are going to be like and what the basis or what those basis opportunities are. Because like right now, our basis levels, we've been talking the last several times we've met, is that basis levels have been very hot.
Yep.
And Columbus has been 10 to 12 over here recently. And on the corn side, Blair's been up in that 10 over. The bean basis is now 20 under in Lincoln. We had been 70 under at one time during harvest, and with 25 cents a carry, that was almost like $1 under the March where we are now. And we're like 20 under, so that's been a 80-cent improvement in the basis. So we'll look at those basis levels later on, but we're definitely looking at new crop strategies at this point, how to start protecting ourselves, because if we do come out with more acres like some of the commercials are projecting, the corn prices could be a lot lower this next year versus where they are right now.
Very well. And so earlier this week we had diesel fuel and fertilizer prices take a little bit of a dip. So how would you advise that producers look at locking in some of their input costs?
Well, we had the Soleimani and Iran was killed, oil prices jumped up to $61 that Sunday night on the markets. Now we're back down toward 50, 51. So we've dropped, $10, $12 a barrel. When you look at those cash, like the diesel fuel prices, they've come down quite a bit. So it looks like a good place to start locking in fuel, because we've had a break in price, but also the seasonals, those same seasonals that we look at corn, as you look at new crop corn being negative going into the summer, the diesel prices are actually positive, or they increase as we go from January into April. So it makes some sense to lock down, start locking down diesel for irrigation needs, transportation, for people that are, for plant, we're in the dry land country or non-irrigated country in eastern Nebraska. We don't have the irrigation needs, but across the state, that's a big deal in terms of locking down diesel for their irrigation needs for summertime.